Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this session, I want to springboard from some of our research that went into this year's thesis paper entitled Sustainability, but for whom? Climate change, green energy, and ESG. Climate change and the inevitable policy response to it, that is, the global energy transition to low-carbon fuels, has in reality begun to drive up prices around the world. The core issue? The world may not have adequate leadership, consensus, nor structure to actually deal with it. The problem in a nutshell is overlap and interrelationship of four areas: poor public policy on three dimensions, climate change and failure of practical policy approaches, global supply-demand mismatches, and global supply chain choke points. We need to first of all discuss the accepted orthodoxy. Over the past year, U.S. consumer prices have risen 7%, their fastest rate in nearly 4 decades, frustrating households and tanking President Joe Biden's approval rating. And no wonder, high inflation corrodes the basic machinery of the economy, unsettles consumers, troubles companies, and prevents everyone from making sturdy plans for the future. Given all that, you'd think economists have a good detailed sense of why it happens. The profession's dirty little secret is they cannot predict it with ease. Economists understand that inflation arises from an imbalance of supply and demand at the absolute highest levels of the economy. The monetarists summarize it simply as inflation is caused by too many dollars chasing too few goods. The fault, therefore, always lies with the dollars being produced, put into circulation. Though this is a fact, it is too simplistic, especially when politicians interfere. I'll show this as a major contributor in a moment, but it must be seen as not the most worrying development. Politicians interfering always cause problems. That's nothing new. Maybe this time it's particularly bad, but anyway. Let's call this poor public policy. Many economists believe that the Biden administration actually, unwittingly, or possibly intentionally, did something unthinkable last year when it passed a $1.9 trillion relief bill into an economy still constrained by the pandemic, flush with $1,400 stimulus checks for every single taxpayer in the U.S., while all stuck at home with Amazon Terminal and COVID-free delivery. Consumer spending on durable goods surged. But where was all that stuff supposed to come from? America's overeager excess of dollars leapt into the world, chasing goods from factories shut down by, at the time, the Delta variant and now Omicron, and ports clogged with shipping containers and a shortage of truck drivers. This was the epitome of just too many dollars chasing too few goods too fast. It went chasing after products like scarce specialty housing lumber from Canadian British Columbia forests. That's just one example. That is a clear example of too much money chasing too few goods. However, some of the biggest causes of today's inflation do not seem related to the sudden surge of dollars. The surge in dollars can't explain why U.S. gas prices are so high, nor why coffee prices are spiking. Let's talk about U.S. gas prices. They're frankly about a massive change in U.S. energy policy, and I'm talking specific to the U.S. here, in that U.S. energy policy has become energy dependent versus independent, at least in the short term, according to the Biden administration. So poor public policy comes in three forms: improper redistribution of wealth, that is about proper fiscal spending; 2, creation of just too much money, that is how we choose to finance the government; and excessive or unwarranted regulation, such as the energy policy that creates a mismatch in demand versus supply. But what we need to recognize is something is going on that is much bigger than just U.S. policy and Federal Reserve money printing. Coffee prices, as we mentioned, are going up, which suggests there's more than just these issues causing problems. Climate change. For years, scientists and economists have warned that climate change could cause massive shortages of major commodities such as wine, chocolate, and cereals, for example. Financial regulators have cautioned against a disorderly transition in which the world commits only haphazardly to leaving fossil fuels so it does not invest enough in their zero carbon replacements. In an economy as prosperous and powerful as America's, those problems are likely to show up, at least at first, not as empty grocery shelves or bankrupt gas stations, but as price increases. That phenomena, long hypothesized, may be starting to actually arrive. Over the past year, unprecedented weather disasters have caused the price of key commodities to spike, and volatile oil and gas market has allowed Russia and Saudi Arabia to exert geopolitical force. This climate change risk to the supply chain, it's actually real. It is actually happening now. Want to see what climate change is already doing to prices? Look to the prairies. Last year, the United States suffered through its hottest summer ever measured, finally breaking the record set during the Dust Bowl summer of 1936. I listened as a kid endlessly to my grandparents talking about the dirty 30s. It was a 10-year phenomenon for them in farming. In the northern Great Plains, searing heat combined with record-settling drought gave rise to swarms of grasshoppers that devoured the wheat crop. Those conditions helped push wheat prices to their highest levels in years. Corn prices also rose 45% last year. We've seen this before. It's very cyclical. If you're a farmer, you're very cognizant of it. But these are pushing envelopes that I will call 2 and 3 and 4 sigma kinds of events. And it doesn't take much to cause these kinds of problems. Even minor 1.2, 1.6 degree Celsius kinds of changes have profound impact. All right, let's look at Brazil, which sagged under its worst drought in 91 years earlier last year. Water levels in the Parana River, a major shipping artery, fell so low that cargo traffic was disrupted. Then in July, a surprise frost struck Brazil's coffee belt, lacerating already drought-weakened Arabica trees. Brazil produces nearly 40% of the world's coffee. The cold snap damaged 2 years of crops at once, burning so deep into trees that it fringed the buds that will become next year's flowers. Coffee prices leapt on the news. Today, coffee is as expensive as it's been in 10 years and doubled its 2020 levels. The companies behind Nestle's, Folgers, Café Bustelo plan to raise consumer prices in response. In Canada, the worst single-year drought since 1961 doubled pea prices, sending them to all-time highs. France is waterlogged, and record-breakingly hot summer also helped to push up global pea prices. Alternative meat producers have made peas more in demand than ever. In Germany and Belgium, days of torrential flooding killed more than 200 people and severely damaged the potato crop, contributing to last year's price increases of 180%. Climate change helped make the rainfall that caused those floods more likely, at least according to the World Weather Attribution Initiative. Climate-added droughts even affected the high-tech sector. More than half of the world's semiconductors are made in Taiwan, most of them at sprawling factories owned by the Taiwan Semiconductor Manufacturing Company, TSMC, which uses 37 million gallons of water a day and faced production issues. Uncertainty. Last spring, when Taiwan experienced its largest drought in half a century and began rationing water. That said, even when bad weather destroys a crop, it doesn't always lead to inflation. Russia, the world's largest wheat producer, produced 9 million fewer metric tons of wheat last year than it did in 2020. But Russian wheat prices fell because the country couldn't sell enough wheat to sustain them. And even though the drought in the United States sent cattle prices crashing, as ranchers culled their herds, meat prices surged. Meat-producing companies passed none of the spread along to consumers. Given all this, you can see why Wall Street and corporate executives are now more concerned about climate change than they were initially just a few very short years ago. But it's not just commodity prices that are going up here. Look at global supply-demand mismatch. The economy shows evidence of a new inflationary regime caused not only by climate change, but by the fight over how to respond to it. And as the world has begun to transition slowly, incompletely away from fossil fuels, it has created imbalances in the energy system. The first mismatch is between fossil fuel supply and demand. According to International Energy Agency data, the world has dramatically reduced its investment in oil and gas production over the past few years. This hasn't happened only because of climate change. Yes, investors are skittish about long-term fossil fuel demand in a decarbonizing world, but they're also angry that oil shocks have performed so pitifully over the past decade. Yet the world has not reduced its appetite for oil. It has continued to invest in cars, trucks, planes, ships, and plastic-dependent factories at a voracious rate, according at least to the IEA in my first-hand experience. Nor is it investing in zero-carbon energy fast enough to pick up the slack from declining oil investment. In 2021, the world put only $755 billion into energy transition. By any historical measure, that was a bonanza amount, but it must be more than quadruple that to $4 trillion in the next decade for the world to avoid more than 1.5 degrees Celsius rising, warming, while meeting its energy needs, at least according to the IEA forecast. These mismatches have allowed oil producers to remind the rest of the world's economy of their power. Oil prices, now at their highest level since 2014, have made up 27% of the excess inflation since the pandemic began. Yet despite widespread Democratic agreement over its terms, the U.S. Congress, as an example, has yet to pass President Joe Biden's climate and energy package, which is supposedly going to relieve this mess. I personally believe it's actually, frankly, going to make things much worse. If the mismatch between producers and consumers continues, higher oil prices and higher prices for energy in general could stick around for a long time. That would be bad for prices, although economists disagree over the role that fossil fuels plays in creating inflation. There is little doubt that high oil prices trickle down to higher costs in the rest of the economy. When oil and gas prices rise, farmers need to spend more to tend to their fields because diesel prices go up, and to fertilize their crops because the synthetic fertilizer is made with natural gas, to get their goods to market because the packaging is made of plastic. The only way to break that cycle of cost increases is to move away from fossil fuels, but that oil producers have demonstrated that they will get a veto over that transition as well. But wait, is it always appropriate to focus on dollars? What if the problem was caused by too few goods? Worse, what if the economy lost the ability to produce goods over time, throwing off the dollar-to-goods ratio? Then what was once an adequate number of dollars will, through no fault of its own, become too many. The solution would be neither to raise taxes nor to slow the creation of money. In fact, if we reduce the money already created, then we would likely prolong the crisis. People would still use their shrinking real earnings to bid up the price of food, but they would have less money to do it with, so everyone would be poorer and hungrier. The government would instead need to import more grain, ration supplies, or plant more farms. The modern global economy is not foolproof or resistant to breaking. Yes, container ships and jumbo jets connect far-flung farms and factories to consumers, which have permitted a planetary smoothing out of prices, but ultimately globalization has stretched many governments as far as they can go, and they remain dependent on certain key and vulnerable places. A single woodland province furnishes timber for most American homes. A single highland country grows nearly half of the world's magic beans. A single foundry on a distant island makes most of the thinking rocks that go inside American phones. Yet if something were to happen to the supply of goods from those places, we always have the same answer. Print more money to fix it. It doesn't work that way. In truth, a combination of mistakes and lack of foresight now besets the American economy and frankly the world's economy. The administration probably produced too much money last year, and some countries are reeling and scarred financially and economically. Yet if the climate scars on supply continue to grow, do the central bankers and global leaders have the right tools and operating relations to actually manage it? Are they managing it? They're talking about it. I don't know if they're doing anything effective about it. A skeptical Canadian lumber trader I read recently said it quite well, and I quote him, "Raising interest rates will blunt the demand for housing, no doubt. But if you blunt demand enough to bring lumber prices down, you're destroying the economy. For us to have lower lumber prices, we can only build 1 million homes a year. Do you really want to do that? Raising rates doesn't grow more trees, nor does it grow more coffee, end a drought, or bring certainty to the energy transition. And if our new era of climate-driven inflation takes hold, then America will need more than higher interest rates to bring balance to supply and demand." How to respond to these problems? The U.S. government has one tool to slow down the great chase of inflation: leash up its creation of dollars. By raising the rates at which the federal government lends money to banks, the Federal Reserve makes it more expensive for business or consumers to take out loans themselves. This brings demand in the economy more in line with supply. The government needs to take back some of the money it created immediately. That's probably what's going to happen, but however, that is politically impossible. A collapsing economy is likely going to be needed to destroy the poorly invested money it created without it actually taking the fall for terrible fiscal, monetary, and public policies. And I'm not talking about just the U.S. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will take the money or it has no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.